Good morning. I'm here with Jonny Price, who's the Director of Fundraising with WeFunder, which is an investment crowdfunding platform for startups. Welcome, Jonny.
Thanks for having me.
Absolutely. Thanks for making time. Where are you right now?
I'm in Nashville, Tennessee. Just moved here a couple of months ago from San Francisco, where I was the last 10 years. Originally from the UK, as you may be able to tell by my accent, although that's been diluted now after living in America for a few years. But yeah, speaking to you from Nashville today. Music City.
Music City. So I wanted to start off today just a little bit about your background, what you're doing with WeFunder, and a little bit more about WeFunder itself.
I'm from the UK, originally started my career in strategy consulting with a firm called Oliver Wyman. Then after 6 years there, both married an American girl, which is what brought me out to San Francisco in 2010. And then also left to work, join a nonprofit called Kiva.org that was doing crowdfunded microloans for entrepreneurs around the world. I was leading our US team that was supporting basically mom and pop shops with 0% interest crowdfunded microloans. So ran that team for 7 years through 2018, and then 2.5 years ago left Kiva to join WeFunder. So still in the space of crowdfunding capital for entrepreneurs in America, but now much more focused on kind of fast growth startups. Average Kiva loan was 5K, average WeFunder campaign is 350K. So it was obviously a bit of a transition in terms of the types of entrepreneurs we were working with. Kiva's model was kind of 0% interest. It's more kind of philanthropic based, whereas on WeFunder, investors are seeking to earn a rate of return in the startups they're investing in. So yeah, I lead our business development team here. So basically responsible for finding great companies that want to raise money on WeFunder. Telling them about the pros and cons of raising equity crowdfunding versus raising from angel investors or more conventional routes. And then hopefully I'm working with them to launch a campaign and get them the money they need to keep growing their businesses.
So I'm interested when you're talking to these founders about the benefits of crowdfunding versus angels. The thing that comes to mind for me is instantly you have this group of people that have a little stake in your business that now advocate for your business as opposed to just one or two angels tapping their network.
Yep.
If you could kind of walk me through the key benefits of equity crowdfunding as opposed to a few strategic angels, that'd be great.
Yeah, so I think there's kind of, for a founder, there's kind of two main value props, right? The first is we help startups raise more capital. And then the second is your point around kind of social capital and supporters and champions. On the first point, if you're running a Reg D and raising from angel investors, like you're limited to accredited investors, you're privately soliciting investors. And so it's just it's a weirdly inefficient process, right? For Silicon Valley, the epicenter of kind of global capitalism and startups, everything's being disrupted, right? It's Airbnb. It's Uber. Everything is being kind of democratized. Twitter, everyone's a journalist, et cetera, et cetera. But with startup investing, it's like smoke-filled rooms and it's pretty antiquated actually. And so our model, in a sense, is kind of like Airbnb for investing, right? So we are putting a startup founder not just in front of 200 rich people in rooms and coffee shops, but in front of 700,000 WeFunder investors, all of whom can invest. You don't need to be an accredited investor to invest anymore. You can invest in startups for as little as $100. And so, and then we're also allowing that founder to promote it. So if you're a consumer-facing business and you've got an army of customers that love your product, now you can get them to invest in you, as well as just being able to raise from accredited investors and institutions. So that's the first big value prop for a founder, is we help you raise more money. And then the second one is you were alluding to, it's look, when you have an angel investor invest in you, hopefully they're adding value for your business. They're opening up their Rolodex and connecting you to folks that can help you, follow-on financing, helping you connect with talent, giving you product feedback, strategy advice, et cetera, et cetera. And so, to a lesser extent, less depth, probably, if someone's investing $500 in your company than if they're investing 50 grand, but more breadth in the sense that, now if you're a consumer facing business, you have a new product coming out, you can get those 1,000 investors to promote that product on social media or to buy that product. Or even if you're a B2B company, you're hiring for a software engineer, you can now have 1,000 people promote that JD on their LinkedIn page. So, and I wrote a blog post actually on the kind of revenue and customer engagement aspect of that recently. We had a company called Neurohacker that have now done 4 campaigns on WeFunder. They sold, they still do sell exclusively through their own website. And so they had very rich sales data. And so they basically anonymized that and shared it with me so I could map their customer data to their investment data on WeFunder. And what I found was 2 things. Firstly, they had a number of people that were not previously their customers who invested in the WeFunder campaign and then became their customers and now are spending tens of thousands of dollars every month. And then secondly, the customers that they had previously that invested in the WeFunder campaign are now churning at a lower rate and spending more money going forward. So that there's it's a customer engagement play of existing customers. So I've talked about those 2 effects for a number of years, more on trust than backed up by any data. This was the first case study I saw of that in action. But so that's in terms of the kind of social capital, like creating an army of brand ambassadors and champions and supporters who can help you to grow your business is the second big value proposition for a founder.
Yeah, absolutely. And I mean, this goes back to, when I first started investing in the stock market, right? It was like buy brands you know and love, but like they're these gigantic publicly traded companies. So when it's a small startup that you feel a lot more intimately with.
Exactly. And that aspect can move the needle for a startup probably more than it can for a huge company, right? If you're fragile and nascent and just trying to come out the gate, that's where having a bunch of champions like who believe in you and are looking to support you because they're financially incentivized for you to grow can really move the needle.
Right. Yeah. It's all about getting that initial traction and having those people right away be your ambassadors. It's invaluable, that's for sure. I want to get into WeFunder and the type of businesses that go on it, but I'm curious more from the investor side. So you have a number of startups, a number of deals on your platform. If you could talk about the type of investor that would be interested for these, the key risks, what is kind of the pitch to an investor interested in looking at the investments presented on WeFunder?
Yeah, so I'll maybe start at a high level. So until 2016, it was basically illegal for ordinary people to invest in private companies. So anyone could log on to Robinhood or E-Trade and buy stocks in Starbucks. But if you wanted to invest in like the cool local coffee shop that was just opened their 3rd location and was looking at expanding in your neighborhood, you couldn't invest in that company, which kind of sucks for you as the investor, but it also sucks for the founder of that company because what's the guy's, Howard Schultz, is it? The CEO of Starbucks, he can go to ordinary Americans to raise capital, but like the guy like with a coffee shop in your neighborhood can't. So both for founders and investors, it was working for the large companies. You could also in 2015 go to Vegas and drop $1,000 on the spin roulette wheel, right? Obviously, investing in startups is highly risky. It's a very illiquid asset. Like a lot of startups will go to zero. It's much riskier than investing in the stock market. Even if there is a return, it might not come for a decade. So it's risky, but we shouldn't lose sight of the fact that anyone can go to Vegas and gamble with very little regulations. So, but for 80 years, since the Securities Act of the 1930s up until 2016, ordinary people couldn't invest in private companies. That was limited to accredited investors, the definition of which is basically you're a millionaire. Literally, you're a millionaire apart from your house in terms of wealth. Well, you can get there on income criteria too. But so, and then in 2012, the Jobs Act plus Congress, it took the SEC 4 years to roll out Title III of the Jobs Act, which then enabled what's called regulation crowdfunding, which is how startups are raising capital on WeFunder. So still, most startups in America, most early stage startups are using the exemption called Regulation B, where they can raise from accredited investors. But now since May 2016, they can also raise through regulation crowdfunding, where they can raise up to $1.07 million per year from unaccredited investors. So now anyone listening to this, and international people, by the way, as well as Americans, you can invest up to $2,200 per year. That's anyone can invest that. And then if your income and wealth goes up in certain scales, then you can invest more. And so if you're a millionaire, you can invest $107,000 per year in regulation crowdfunding. So it's kind of a pretty new thing. It's only like 4 years old that, you know, anyone in America has been able to invest in these private companies. And so then to your question, what type of people are looking at investing in these startups, or what kind of investment opportunities are these? So again, I would highlight, you know, it's very high risk, right? It's much lower risk to put it in a public company that's been established, they're probably not going anywhere, versus like, you know, very, very early stage startup. And there's liquidity in public markets. So you can, you know, buy shares and sell them again the next week if you want to. Whereas with investing in private companies, that liquidity is usually a lot more difficult. So it's much more of a long hold. So those are two important criteria. The tagline, if you go to the WeFunder website, the tagline that we have for kind of pitching investors, I guess, is invest in startups you love. So not to say that all investors on WeFunder are only investing in startups that they love. You know, they might be doing financial analysis or looking at a whole host of factors, like, you know, the buyers of the team, or like the market, or the product, the traction, the financials that they have, etc. But above all, I think what we would love our brand to stand for is what we do is we enable people to invest in startups that they love, which might be the brewery in their town that, like, they know the founder, they've been going to that brewery since it opened. Now the brewery is like expanding, and they get to be an owner and like be along for the ride. So it might be a brand, a consumer-facing brand that they love, or it might be like they're passionate about space and they like know a ton about space. They're like an 18-year-old like college kid. They're obsessed with space, and there's like 3 space companies on WeFunder, and they can like devour the information on the profile. There's a ton of information, and then like try to reach out to the founder, get connected to them. And then if that founder's like jiving with them, then maybe they invest in that company. One of my favorite examples on WeFunder was, well, I live in Nashville now, Tennessee, just down the road in Chattanooga. There was a soccer club called Chattanooga FC that raised with us. And so they raised $850,000 from 3,500 local Chattanoogans. And, you know, that was just like the town coming together to now become owners in this soccer club. And they're getting discounts on, you know, tickets. They're getting their name on a shirt that like features every investor. You know, they go into the home games and they feel this sense of ownership and pride. And that's maybe the last thing I'll say is that, like, you know, what do you get out of being an angel investor? Obviously, you're looking to make a financial return. And Jason Calacanis invested $25K in Uber, made $125 million in the IPO, 5,000x return in a few years, right? So the upside, it's high risk, but there can be some like crazy upside winners here. But the bigger piece for me is like the investments I make on WeFunder. It's like, it's really cool to be connected to this founder that's like just a brilliant person, an expert in his field, like super driven person. You get to be involved with that, like get almost like a seat on, you know, on the elevator, if that's all right. I don't know if that's a good metaphor, but yeah, that's kind of for me what it's all about.
Hey, I'll take a seat on the elevator with the founder any day. You know, there should be seats on the elevator anyway.
This chair is so long; it goes for so long that you actually need to sit down.
Well, I don't even know how elevators work right now with COVID. Anyways, like, are they one person on the elevator? You're just gigantic.
Sterilized seat.
Get into your bubble. Yeah, it's an experience. All right. That's awesome. I mean, I like the Chattanooga Football Club. That's a great example of like really rallying behind your local community, your local businesses. These things always really resonate well with me. And I love that ownership, that sense of support. But ultimately, like you said, these are investors. There's an opportunity cost. If I'm putting $500 into this startup, that's $500 that I could have put somewhere else and gotten a return. And although, like you said, the returns are pretty asymmetrical, like crazy risk return, super high risk, but super high return potentials as well. I'm curious, something else that you had mentioned is the lack of liquidity. So the idea with traditional startup investing, you put it in and then 10 years later, maybe there's an IPO or a liquidity event, and that's how you can then have liquidity. Do you have any secondary market liquidity on WeFunder? Is this something in the works, or are you pretty much locked into some major liquidity event as an investor?
Mostly the latter. We have had some secondary sales, which we can kind of facilitate on an ad hoc basis. Your securities with regulation crowdfunding this exemption are locked up for at least a year after you invest legally. In the long term, we imagine there being a vibrant secondary market here. Given this is such a nascent sector, that we've done 100 million. We just passed 100 million in regulation crowdfunding volume. I think we're the first platform to do that. Probably the market overall is like 300 or 400 million. So it's still very, very nascent. And so right now, there's not really enough liquidity for us to justify building a secondary market. But over time, as the number of companies and investments grows, we will build a secondary market. And we've already had some interesting discussions as a team in terms of how we're going to structure that and how we can kind of get away from the kind of quarter to quarter, short-termism of the public stock markets, which is obviously what you want if you're building a private company. So we're kind of intrigued to try to build that in the right way. But in terms of prioritization on our engineering roadmap, we haven't really seen the kind of demand or liquidity to build that in 2020.
I'm totally spacing who it was, but there's a prominent guy within the startup world that wanted to do that long-term stock exchange. Yeah, it was Eric Ries. Okay. I knew it was one of the big ones. I couldn't remember who it was. I mean, the issues that come, the short-term thinking of optimizing for this quarterly report at the detriment of the long-term, and especially with somebody like a local brewery or something. I mean, come on, if they're worried about quarterly earnings reports, it's going to completely torpedo the model. But that's the other thing. I think that secondary market is vital for this equity crowdfunding of SMBs, because they're not going to IPO. I mean, very, very unlikely that the mom and pop coffee shop that I bought an equity stake in is gonna IPO. You never know.
And on that note, because that's a great point, there are other investment structures on WeFunder as opposed to, the kind of hockey sticking startup, like convertible note / price round, everything's gearing towards the exit in the acquisition or IPO, right? So there are equity contracts where it's like a long-term hold, and in a local brewery or restaurant, it might be that investors are being paid out in profit distributions over the years, right? So Hopsters is a brewery that raised $1 million on WeFunder to open a second location. Their investors were getting 80% of profit distributions. They got their money back, then it flipped to 20% thereafter. So that was kind of the payout as opposed to an exit. And then we have debt offerings as well, either fixed interest rate loan or a revenue share deal where startups or companies are paying X%, call it 5% of their revenues back to investors until they earn a multiple on the principal. So maybe it's like a Hops and Grain is a bar in Austin, a brewery in Austin that did $1 million revenue share loan. I think their investors are getting paid back 2x, so $2 million. I think it was 5% of their revenues over the years. So certainly don't need that exit for the investor payout. To your point, in the majority of cases in WeFunder, that is what investors are looking for and what we're kind of gearing towards.
Awesome. Yeah, no, it's good to have that optionality. I mean, because you put in $5, you want to pull out more than $5, or at least have the opportunity to pull out something at some point.
Yeah. And just on that, I guess this is more on the founder side, I think, than the investor side. But I think there's a little bit too much homogeneity of investment structure for startups in America. So it's really it's the equity path, right? And that's the narrative. That's what everyone talks about. And that's kind of what everyone is almost kind of shoehorning their journeys into. And I think there's an increasing kind of movement towards, exploring alternative investment structures. The revenue share financing one is a good one. I chatted with someone from a fund called Earnest Capital. I think they're out of Seattle, maybe, and they have this shared earnings agreement where, if it becomes more of a lifestyle business, then investors can essentially like get paid back out of profit distributions of the business. And so I do think there's kind of a movement towards like alternative investment structures that might be a better fit for some companies. And the cool thing about WeFunder as a platform is that, whatever structure is going to work for that founder and investors in that company, we can have on the platform. So, the majority of campaigns have probably been safes, convertible notes, priced rounds, revenue share, financing. Those are probably accounted for about 90% of the raises, but there's another long tail of 10% there, which is kind of like a weird and wonderful array of investment structures, trying to kind of tailor the investment structure to the needs of the founder and what's going to work for investors.
Yeah, I really like that. Although I think it would be difficult for you guys as a platform to help educate. I mean, people understand equity, right? They understand this sort of thing. They understand rev share. Like, these things make sense. So I'm curious, it sounds like 90% of it goes into these more normal. Yeah, exactly. What is like the most unique investment structure that you've seen? Unique meaning it has a lot of benefits for both the investor and the founders. It's not unique in the fact that it's just crazy and doesn't make any sense.
Yeah, I mean, I can't think of a super unique one off the top of my head. I mean, the Hopsters example I gave is, in the world of like startups and like angel investing, I mean, that structure of an equity swap is a little more common with Main Street businesses like breweries. But, in the world of startups, that model of 80% of profit distributions till you get your money back, then it flips to 20% is, I guess, a little more unusual. And that's certainly not one of the standard template contracts that we offer. The other piece that's like interesting to consider here in terms of like investor returns is perks, right? So a lot of companies on WeFunder are offering perks similar to Kickstarter style perks for people that are investing. So, if you're like Fancy as a company that's live right now, wefunder.com/fancy, and if you invest $1,000 in them, you get a 15% lifetime discount on their website. If you invest $2,000, I think it's a 20% lifetime discount. So, that could almost be seen as an investor return in itself. Is another thing that could be factored into the calculation on returns.
Yeah, absolutely. I mean, it is a return, right? It's a monetary benefit for you. It's just coming in a different way. So it sounds like you have all sorts of different companies on your platform. So you have the high growth, you have the local breweries, you have the local sports clubs. From an investor perspective, what sort of companies have seemed to do the best, and what sort of returns are you looking at for those sorts of things, and time horizon?
Yeah, so I mean, there's a question on like what companies have had the most success in raising money on WeFunder, which is easier to answer because we have that data. And then there's another question on which companies have the most like returns for investors, which is harder because we don't really have that data yet. In terms of the companies that have done the best on WeFunder, consumer-facing businesses tend to do better, just for a couple of reasons. I think one, if they have a big audience of customers that love them, and they say, hey, we want you guys, our customers and community, to be our own than us. Like, we'd rather that you guys are kind of participating in our success than these institutions and banks, then that can help them to raise money quickly. So that's one aspect. And then second is those consumer-facing businesses probably see more value in recruiting an army of investors who are going to be loyal customers and brand ambassadors. And so for those two reasons, I think B2C tends to be the sweet spot. We've funded a lot of B2B companies as well, but B2C, I would say, is slightly more in the sweet spot. And then, I would say the best determinant of success when we fund raising money quickly is having a great company, right? So it's quite interesting to me that we've done a number of Y Combinator alumni have raised capital on WeFunder, and they tend to do very, very well. So if they have that YC stamp of approval, all the reasons why Y Combinator selected that founder and that team, that company, tend to then translate into success on WeFunder. So if you have a product that's growing rapidly, a team that's incredible, a market that's huge, that's probably the number one determinant of success on WeFunder. And then also like audience size, like ability of the founder to hustle is also going to go into their success and in terms of raising capital. And then in terms of investor returns, I mean, kind of a nice thing. This is a little bit more kind of hypothetical at this stage than kind of in the rearview mirror. But the cool thing for me is if you have a consumer-facing business where the customers love the product so much that if given a chance to invest in that company, I mean, this is like what you were saying with the stock market before, right? Like you invest in companies whose products you love. If that's happening on WeFunder, like if you are a company with a product that has a ton of people that love it, that's probably a good thing in terms of like long-term investor returns. I mean, obviously there's a long journey and it's the founder, and whether they can like make that journey. Obviously, like having a product in itself isn't a guarantee of long-term investor returns, but hopefully there's a pretty decent correlation. Before the SEC rolled out regulation crowdfunding in 2016, WeFunder was focused on Regulation D investments, like essentially like crowdfunding for rich people. And so we invested in a number of companies in those days. And so we have a little bit more. We have now kind of 4 years worth of historical data on this. So we have a little bit more data on returns. And so far, those returns are very good. I'm on our wefunder.com/results page now. And as of July 2020, our unrealized net IRR was 31%, which is pretty awesome. We have 4 companies that are now valued at over $1 billion, being Zenefits, Checker, Ginkgo Bioworks, and Rappi. And so there's obviously, as with all kind of venture investing, like there's a somewhat of a power law at play here. And so those companies and others that have done well have driven pretty impressive results on our Reg D portfolio. Reg CF is kind of interesting. Like when the law came out in 2016, there was one element, which is that we couldn't roll individual investors up to one line on the cap table. And for the very best like startup founders, that was a problem. And so it was like, harder for us to, I would say, recruit great companies in those early days of regulation crowdfunding. We certainly had some great successes. Beta Bionics is one, Mind, who raised $1 million to make an artificial pancreas. They just closed a $50 million Series B from Novo Nordisk and other strategic investors. But the 1,000 people on your cap table thing was just made my life difficult. So
I can't imagine. So each individual investor through WeFunder gets a spot on the cap table. They're not grouped into one.
Previously, yeah. So through up until 2019, that was the case. And yeah, that was then a deal breaker for a lot of founders. And so then this year, we rolled out a new structure using a custodian whereby we can roll individual investors up to one line on the cap table. So, and we have a lead investor component that goes along with that, where the startup founder is designating a lead investor, hopefully a really, really awesome angel, to play the lead investor role on WeFunder. That lead investor is then earning 5% carried interest on the whole round. So there's some financial compensation for them if the company does well and does throw off investor profits long term. And so this is now meaning that all of a sudden now that a lot of founders that previously might have gone the Reg D route are now all of a sudden considering WeFunder. And so I think that's going to bode very well for our long-term returns. The other piece in 2020 is COVID. So I think like, especially in March, April, a lot of angel investment capital dried up. And so then founders who, again, even with the one line on the cap table thing, might have gone the angel route, were now coming to us and saying, oh, I'm actually, need a bit of help closing my round here. And so I'd say that for both of those reasons, the one line on the cap table / lead investor structure and also COVID has meant that the quality of startups we've been talking to and launching recently, I've noticed a significant improvement, which is awesome. And our investment volume as well has been growing very significantly, obviously at a time when a lot of businesses have been struggling.
Yeah, that's great to hear. Well, it's another avenue, right? And so I'm curious with this new structure, the all one line on the cap table, the 5% carry for the lead investor. did this represent an increase in cost for investors on the platform? What kind of are your costs? Did this impact it at all?
It does, yeah. It's essentially, it is a dent to their profits at exit, if there are profits, right? And for us, this is a trade-off that it makes a ton of sense to make, because this whole structure, the one line on the cap table piece, bringing the lead investors in here is going to mean, firstly, we get higher quality companies on the platform. And then secondly, the lead investor having this 5% of carried interest is now incentivized even more to help that company to grow and succeed. And so the combination of those two things should, we very, very passionately believe, lead to more than a 5% improvement in returns. I mean, it's probably like, hundreds of percent improvement. And so it's a trade-off that we think is worth making. And if you look at like how Angel List is structured, for example, in the Reg D world, I think typical carried interest is 20% there. So it's certainly a lot less than in that on that platform.
Okay. And what are the overall fees on the platform? How does it work?
So, for an investor or for a founder, typically you're paying 7.5% of the amount raised. For an investor, you pay 2% of the investment amount with a minimum of $8 and a maximum of $100, I think, off the top of my head. And so if you're investing 10 grand, then it works out at $100, so 1%. If you're investing, $250, then it's $8, so it works out at a little more than 3%. I think the weighted average fee on the platform works out at 1.5%.
Okay. That's reasonable for access to these early stage companies that you wouldn't have access to anyways. You guys manage the cap table, all of this stuff, right? So I'm curious, it sounds like this change for the cap table, a couple of these things have upped the quality of the businesses that are crowdfunding on your platform. Mm-hmm. But I'm curious what sort of filters you have to actually weed out some of the really terrible ones. I mean, do you have very plain Jane has to have this track record, this revenue, this many years of experience? Or if you could just expand on that a little bit more.
Yeah, it's interesting. We've actually made a movement away from screening for quality in the last few months or so. And I think we're trying to strike a delicate balance here. I think we're doing a pretty decent job of it. But, on one hand, we pride ourselves on being, and we aspire to be, a platform where the best companies go to raise, because the product is best, our team is best, the structure that we have with this custodian one line in the cap table, the lead investor piece, the XX team that we're building of mostly Y Combinator alumni founders that can provide mentorship and support for founders we're investing in. Bringing all these things together, we want to make it such a no-brainer that if you're, a world-class founder looking at bringing on an army of champions for your business, you're going to go with WeFunder over our competitors. But at the same time, we also don't want to be the gatekeeper. We don't want to be the VC. Like a big part of our model is like, we want to kind of be a platform, I would say, and kind of a democratized platform. And right now, 77% of venture capital goes to 3 states, California, New York, and Massachusetts. And we're a B Corp, PVC. Like a big part of why our founders built WeFunder and why I work here is to get more capital flow into Tennessee, where I am. And so we kind of want to get out of the way a little bit. While on one hand, we're gearing our whole product and our whole kind of strategy towards working and being the best place for a world-class founder to raise $1 million, or the SEC are now looking at lifting the limit to $5 million, which will be very, very cool again for like the caliber of companies that we're launching on the platform. But at the same time, even if you're a guy in your garage with an idea just starting out, if you can get people that trust you to invest 10K, then we'll go ahead and do the legal paperwork and launch you on WeFunder and, at least give you a shot at running a successful campaign with us. In a sense, the other day I came up with a alliterative phrase, which I kind of liked around friends and family round, we can streamline it, systematize it, and supercharge it. The streamline is basically, rather than having to have a ton of meetings and a ton of like sending stuff by email to the same people over and over again, it's just like there's a website, people can get their credit card out and invest on the site. It just saves you as the founder time. The systematized piece is, friends and family round. Got like Uncle Joe, like did he agree? Like, did you set a valuation, a share price for his investment? Like, how's that treated on the cap table? Whereas for us, it's like one line, it's all there. It's a contract, it's an electronic contract. It's very systematized. And then the supercharge is like, we'll put you in front of WeFunder's investors, and maybe you can make connections with people on the other side of the world who are really interested in what you're doing, and you can kind of thereby raise more money. And so I think, our vision, our founder's vision, my vision too, is like, we're about helping the little guy, and giving her a shot, as opposed to, just working with like the kind of, Y Combinator alumni that are kind of already on that path. So it's a delicate balance that we're trying to strike. But I think, the last few months, we've been making good progress on both ends of that spectrum. We've been launching a ton more companies and basically getting out of the way ourselves as a bottleneck. But also, as I said, like the caliber of the companies we've been launching has been outstanding. We partnered with, we have kind of a chip with this XX program that has an accelerator that's focused on 13 companies tackling COVID. And those 13 companies have just graduated from this 3-month accelerator program. We had a demo day and launched them on WeFunder earlier this week. And the caliber of those companies is very, very exciting. So yeah, on both ends of the spectrum, I think we're making great progress right now.
Oh, I'm a big fan of this democratized access, easy raising for everybody. But there is a bit of you as a platform, you're putting, yes, you're an open platform, but is there a minimum raise or anything like that? Because ultimately, you're putting it on your platform. Me as an investor jumping on there, I just kind of assume that it's not just this fly by night sort of company. So is there any way for an investor to tell, is this a lower quality company, or am I just kind of a lemming and like following the crowd and a bunch of people have already funded this? Because there's a bit of that, right? The herd mentality. This one's really filling up quickly. So FOMO, emotion, all of these things. Mm-hmm. So as an investor, how do I do my own kind of high level filtration of what are the higher quality offerings here?
Yeah, so we've made a number of product changes recently to really try to bring that out. So the lead investor piece is one of them, right? So every company that publicly launches on WeFunder needs a lead investor to invest at least $1,000. Average is probably coming out more like 20 or 25K. And the lead investor's role, probably more so than we've had previously, that lead investor is looking to negotiate on the terms of the offering, like at the outset of the process. And so who that lead investor is, how much they invested, they kind of, their rationale for investing, I think is one like product change that we've made recently to try and bring that out for investors. Another piece would be that we have every company that we publicly launch do an expert interview panel. We've had some really great experts, deep sector experts, put founders in that sector through their paces. And that video we highlight on the campaign pages. So in those two ways, we're really trying to enable anyone who's looking at that page to really get a good sense of where this founder is on the journey, the caliber of the team. There's a Q&A section that you can get into. We've tried, I think, versus our competitors, we've tried to make the financial information on the company, for example, very, very transparent and prominent on the campaign page. So any WeFunder investor just knows where to look for that and can easily compare across companies. So I say that's how we're looking to answer that very good question that you asked, which is like in the design of the product. And so I guess going back to the point on like, the kind of open platform to like prevent ourselves as being the gatekeeper and give people their shot, but also really doubling down on quality. Part of the balance to strike there is like, yeah, how do we kind of highlight the best companies to investors, and as you say, kind of communicate that. Now, this is where, from a regulatory perspective, as a platform, we can't say this companies are good, right? Invest in this, don't invest in this one. We're not allowed to do that from a compliance perspective. So that's where, with the lead investor product feature, with the investor expert interview panels product feature, we're trying to kind of enable investors to kind of figure this out. And obviously there's like investors doing their own due diligence. And then to your point, there's like, the kind of the wisdom of the crowd. And our hope is, the best founders that are really shining, our product is kind of enabling them to shine and enabling them to raise the money that they're looking to raise.
Yeah, I mean, that makes sense, right? It's always balancing this. You want to be this open platform, but you also allowing anybody to raise, but you also want quality things because ultimately you're taking care of your investors as well.
And of course, like there's a ton of like, restrictions and there's a lot of policies that we have where we would, and there's a lot of kind of, black and white due diligence where it's like fraud checks and bad actor checks and all that stuff. I mean, that goes without saying. But then it's more like in terms of like assessing whether this is a quality investment or not. That's where I think, on the spectrum versus like, VC that's making the decisions and like open platform, in the last couple of months, we have shifted a little bit more towards saying, we're not necessarily the right people to judge whether this coffee shop in rural Ohio is a good investment opportunity for people in that community to consider.
Right. No, I mean, that makes sense. I'm curious, you as a company, WeFunder, do you invest in the companies in your platform?
We do not.
Okay.
Our pricing structure previously was that we took a percentage of equity in the company as well as cash fees. We want to get back to that in the future. We wanted to get to cash flow break even in the short term. And we did. Last year, we basically became in the black month to month, and we're still there right now, which is very, very nice. It just kind of gives us a lot of flexibility in terms of strategy and growth. So, but in the long term, we are hoping to lower our cash fees and come back to introducing an equity fee.
Yeah, absolutely. If you can cover your costs, and congrats, by the way, being profitable and surpassing that $100 million milestone, that's gigantic. So big things for WeFunder coming up, that's for sure. Another thing you had mentioned was the ability to take on international investors. So I'm sure it says it on your website, but most other countries, obviously there's certain ones that are excluded from like everything, but
Yeah, exactly. Pretty much very few restrictions. Weirdly, certain provinces in Canada, we've heard, don't allow their citizens to invest. So if you live in Quebec, sorry, you're out. But vast majority of.
All right. And I'm curious, the range of valuations of most companies going on your platform, like what's kind of the low bar, what's kind of the high bar, and kind of the median?
So low bar, I would say, is like sub $1 million. There was one company, Modern Times, that raised on a $250 million valuation. They had tens of millions of dollars of revenue, established brewery. But usually the upper bound you'll see is kind of 30 million or something like that. That really was an exception to the rule. I would say the median is probably around 5 or 6 million, something like that. And the average raise is $350K. Although a lot of companies are targeting $1 million, so call it 5 or 6 million for 15-20% of the company.
And then for investors on the platform, they always need to choose specific companies to invest in, or do you have this like auto investing, jump into a basket of these startups sort of option for people?
Yeah, you're choosing individual companies, which is both kind of legally a constraint right now that you kind of, the SEC wanted investors to be making individual decisions. But also I think like a little more in line with our brand and vision. it is an interesting idea to consider, like a index fund, type approach over time. But I think like that tagline that we have on our homepage of invest in startups you love, it is kind of more conducive to that, to say, yeah, we want people to really be, just like, ideally saying, wow, yeah, I love this founder, I love this startup, I love this idea. And so making that kind of individualized, personalized choice each time.
The mix of investment that you're seeing through WeFunder platform, do you see some institutional interest, or are they most individual investors, like you said, interested in this individual company?
Occasionally, we have institutional investors, and I think with the lead investor structure, we've started to see a few more kind of institutions come in and play that lead investor role. But the vast majority, even of dollars, certainly of number of investors, is individual people.
And your source of deal flow for these small businesses, obviously, you guys are a lot bigger now. People have heard from you; they're going to you as the source for this. But you mentioned that you were working with an accelerator. Is this kind of a key deal flow? Like, how does the deal flow work for you guys?
Yeah, absolutely. So we have a number of different strategies. So I'd say we're getting a lot of inbound. We have a lot of partnerships with, bankers and lawyers and, the ecosystem of people that work with startups who are, referring companies in their community over to WeFunder. And then, we have a lot of outbound as well. So just trying to figure out, what startups are raising capital and how can we reach out to them and just enable them to consider WeFunder as an option, And some people are going to want to go the traditional route for a bunch of reasons, but I think startups, and especially again consumer-facing startups, like you should be considering this at least as an option and weighing it up. And so yeah, those are the three kind of principal strategies we have on the BD side.
When thinking about the type of investor that invests in the platform, obviously we've been talking about it a lot. I feel a lot of conviction for this local company, or the prospects of this sector look really good. But in terms of what kind of investors do you not want? So they need to come in with the mindset that this is a 10-year investment, that I might be getting these like perks and a little bit of ownership and these sorts of things. Like, how do you help an investor think through kind of their first, if you're explaining it to a family member of like the benefits of investing in WeFunder, what key attributes or characteristics would you want them to have before doing that?
Yeah, I think certainly would want to highlight the risks, right? We've talked about them mostly. It is high risk here, and it's also kind of relatively illiquid as an investment. And then on the plus side, I think again it will be like invest in startups you love being like the tagline. Like we have an investments Slack channel at WeFunder where every single time someone makes an investment, it's as we get a Slack message in this channel. And I can remember when I first joined, it was relatively sporadic. Like I just can't keep up with the channel anymore. It's awesome. Like I look back an hour later and there's like hundreds of messages. It's really, really cool. But we also in that channel have a message that the investor, after they check out, then there's a box that comes up like tell these founders why you invested in them. And so we see all these messages come through, and it's so cool to read those messages because the vast majority of those messages are like, oh, I know Ben, we go way back, and this guy has the drive and the determination to make this work. Or it's like, I live in Chattanooga. I've been going to the Chattanooga FC games for years. Like, I'm so proud to be an owner of my team's soccer club, or like, I just love your beer, or like, I've kind of seen, I've been kind of researching and I know the AI space. I work for a company in the AI space, and like I really am excited about the direction that you're taking this company. And we can see these messages, and that for me is like what we're about. That's the investors we want, is like people that are writing those messages. There was one company and only one of the 500 that we've funded on WeFunder, I think it's about 500. And only one company that I remember where all the messages were like, I want to make a ton of money. I think I'm going to make a ton of money. Oh, I'm just investing here to make money. And it turned out that that company was basically fell afoul of SEC regulations, and we had to delist them as soon as we're very, very strict on the stuff. So as soon as we heard a whiff of that, boom, they were done. And it was so interesting that that was the one company where these messages like why people are investing were they're all kind of motivated by making a quick buck. So that's kind of, I guess, the brand and the kind of the sweet spot, I would say, for motivation of investors.
Yeah, that makes sense. I like that, actually. I'm curious, on your platform, do you track like failure rate of these successful investments that have just gone out of business or something like that? What kind of are the numbers there?
We do. WeFunder.com/results has all of the results that we have. Yeah, there's a bunch of stats on that page. The 31% unrealized net IRR I mentioned, the 4.3x return multiple, 72% startups still active, 86 of 120, 38% went on to raise a Series A over 3 million. So you can see the stats there.
Yeah, and I'll link that in the show notes. It's a good results page. None of these are publicly traded yet, though, right? I see Zenefits is the best. It did a 500 million Series C, so they're valued at $7 billion. So I'm curious what changes. So assuming Zenefits like does an IPO and is publicly traded, all of these shares then like walk me through the process for these pre-seed or seed investors going public in their unicorn startup.
Yeah, so I'm probably not the expert on that process. It will function very similarly to how it would with if they'd done that, $1 million WeFunder rounds through accredited investors in a Regulation D round.
Well, hopefully we get to see that in real time.
Yeah, that would be nice. That'd be a game changer. Yeah, the first WeFunder IPO will be a nice moment.
I mean, it's going to happen eventually, right? You've got 100 million. And I go back and forth with this. It's like, well, it's a new platform. If they haven't been around for a while, so of course interest is picking up. But I don't know if, like, peeling back the onion a little bit, like, what is the interest in these startup investments? Is it because over the last 10 years we've had this crazy onset of cheap money and it's kind of just flowing to more and more high risk investments? Is it because of all of these super sexy 500x returns that everybody's hearing about with tech startups? And even though they say they want to support the business, there's a bit of greed down there that you're like, I want to put in $500 and get a check for $50,000 at some point. That sounds great to me until the tax bill comes, but it still sounds great. I'd happily pay the taxes; it'd be fine. But I'm curious what that bigger trend is, and I know nobody knows. So
yeah, I think that the majority of investors on WeFunder have been recruited by founders bringing their network to invest in them, right? So I think that says, for me, it's a little more about like affinity with that company or relationship with that founder, which obviously like I've probably been too kind of anchored on, like, as you were saying, like community and like in the last hour or so, right? Like, of course, like investors on WeFunder want to make money, right? Like, I'm sure the vast majority of investments on WeFunder believe, that this is a good bet financially. Otherwise, they probably wouldn't make it. But yeah, like that, we haven't seen a huge. Maybe in the early days when the law changed, there was kind of a movement of people that were frustrated that previously they legally weren't allowed to invest in cool private companies and now they can, and so there's that kind of movement piece, but I think for the most part, the investors are coming from the founders' outreach and through relationships with the companies. And so that says, for me, in terms of your question on like motivation and like who are investors, it's maybe a little more like driven by that as opposed to just kind of a like widespread desire to shift their investment portfolio from kind of public stocks to early stage private stocks. But maybe I'm wrong on that. It's definitely both. It's just if I look at the, where we're finding investors and how they're coming to WeFunder, and I don't know, maybe there's just an opportunity for us to do more kind of brand marketing and marketing of investing in early stage private companies as like a thing in itself. But one thing I'll say, this is just like in the weeds a little bit, but if you look at return on ad spend of our Facebook ads, if we're advertising like investing companies on WeFunder, our return on ad spend is a lot less than if we're saying invest in this one company. And like, let me tell you about the founder and the growth trajectory, and the ROAS we see on ads focused on specific companies is significantly higher than on the concept of investing in startups overall, which is interesting.
Well, it's a much more target audience, I would think.
Yeah.
So I'm curious with WeFunder, what next features, upcoming roadmap, what excites you the most over these next couple months, couple years, whatever?
Yeah, I think at a high level, it's basically continuing to focus on quality and just basically attracting the best companies to raise on WeFunder. And there's a number of ways in which we're trying to do that. I mentioned the lead investors piece. I mentioned the expert interview panels. And so our product team is an endless source of, I think, pretty brilliant ideas to try to, both kind of enable investors to kind of understand the investments and the companies that they're investing in, and thereby enable the rockstar amazing founders to shine through the product. But also then after the raise, I mean, that idea that like if you have 1,000 investors on your cap table, that's 1,000 brand ambassadors and champions. Like that's really powerful. But like there's so much more we can do on the product side to like bring that to life, right? So imagine if you're like walking along, or you like go into a restaurant, and then because you're an owner of that restaurant, you like get some like discount code pop up on your phone, like or like some like jobs board for WeFunder portfolio companies, or something along those lines, where we can just kind of help founders to realize more benefit from the hundreds and thousands of investors that they have through their WeFunder campaign. So pretty kind of, I guess, high level and abstract, but those would be the two main directions of product changes that I'm excited about over the coming months and years.
Yeah, absolutely. I mean, those are the gigantic benefits of doing this. Good. So where can my listeners find out more, follow you, the company, find out more about WeFunder? Yeah,
WeFunder.com. You can go from there. If you're a founder looking at raising capital, or a founder looking at raising capital, there's a raise money page there. You can click to view the companies. If you click explore, I think we have over 100 companies that are raising right now. You can filter obviously by location or sector, and there's various tags. So you can look at like Y Combinator alumni, for example. And yeah, we're on social media. I'm Jonny at WeFunder.com. If you have any more detailed questions for me, you can find me on LinkedIn, Twitter. I'm Jonny C. Price. Yeah, that's but you check it out. It's cool. Like anyone listening to this can be an angel investor, even if they're not accredited, for $100. It's like such a low barrier to entry, and if you're really interested in startups and angel investing, it enables anyone to dip their toe in the water and get started on that, and learn lessons for much, much kind of lower risk and lower cost. And yeah, it's really cool to be like, it's been such a privilege for me the last 2.5 years. I've worked with probably hundreds of founders and got to know some really brilliant people, pursuing their passions. And so it's fun to be investing in these companies and along for the ride on that seat in the elevator.
That seat in the elevator, man. I'm going to think about that every time. Well, whenever the next time I'm in that elevator, which is TBD, I suppose. Jonny, really appreciate it. Thanks for sharing all your knowledge about WeFunder. I'm excited to see you guys grow and thrive over the next years.
Thank you so much, man. This was a really fun conversation.
Yeah, I appreciate it.
Cheers, Ben. Bye.